Let's rock and roll. Hey, Tim Bratz here. I want to talk to you guys today about like ways to passively invest and lend money in real estate. There's two major ways that we're going to dive into, and then a third kind of specialty way that we'll share at the end. So a lot of the people who reach out to me about real estate aren't necessarily interested in actively operating real estate and having to get their hands dirty and go through all the work. But they either have money themselves or they have access to money, some capital, that they're looking to deploy into real estate. And a lot of the questions that I get are, hey, how do I go through that process? How do I lend money? What should the returns look like? What kinds of investments are there? And there's two major types of investments in real estate. One is a debt loan, and two is an equity investment. So I'm going to break down both of those for you, and then I'm going to talk to you about a third way that is really neither of those, but kind of both. So the first one is a debt loan. A debt loan is when you lend somebody money on a piece of property. Let's call it a single family house for $100,000. You lend somebody money on a single family house for $100,000, and they pay you a fixed return on investment regardless of the property's performance. So whether that flipper or wholesaler or real estate operator makes $200,000 on that house, or they make $10,000 on that house, or they lose $20,000 on that house, it does not adversely affect the lender in any way. The lender still makes a fixed return on investment. And that can look like anything from 6% up to 15, maybe even 18%, depending on the length of time that the money is out there and the level of risk in that deal. So here's what it looks like. You lend $100,000 to somebody, they're gonna flip a house over the next 6 to 12 months. They pay you a fixed return on investment, let's call it 10%. They pay you 10% on your return. You're backed by a mortgage and promissory note on that, and you're listed as an additional insured on the insurance. You're secured the exact same way that any bank would be secured by giving somebody a mortgage on a property. The difference is it's a private money loan. There's no reason that you couldn't be a private money lender just like the banks are. So you lend money on that house. They go and they buy it with that $100,000. They fix it up with that $100,000. And they turn around and they resell it for $150,000 in 6 months down the road. During that time frame, they're paying you on a monthly basis, what is it, I guess a little over $800 per month in passive residual mailbox money that hits your bank account on the first of the month or whatever the terms are that you outline. When they sell the property, you get all your money back, you've earned your return, and you're out of the deal. They make the spread of whatever the difference was between their all-in cost and the sales price, and everybody moves on with life. That is a debt loan. The good part of debt loans is that you have very predictable return on your investment. You know exactly what you're gonna make before the deal sells. The downside is that if you help somebody make $50,000 or $150,000 on a deal, don't you think it's only right that you should get a piece of that too? But you also don't have the downside risk. So it's some one of those things that you just want to weigh out and see what your risk tolerance is and what's more important to you. There's no upside, but there's also no downside. It's a lot of predictability and cash flow. If that's what you're looking for, that's a great way to lend money. Another thing is how it's taxed. It's taxed in your earned income tax bracket or as interest income to you. So you get a 1099 at the end of the year. And then when you get paid all your money back, you go and source another deal, look for another deal, and lend on another deal. So that, I just got smoked by a leaf. So that gives you a good general picture of what a debt loan looks like. Now let's dive into an equity investment. An equity investment's a little bit different. Let's say somebody's buying an apartment building. They would go get a bank loan for about 80% of the money. And the other 20% of the money is where an equity investor would come in and invest. So let's say it's $1 million building. The bank would then lend the money, about 80% of the total cost, where the private lender or the equity investor would bring the difference, about another $200,000. For that $200,000, they may not get a fixed return on their investment. They might earn a preferred return if the property's performing. But if the property's not performing, there's no real money to be paid out. And so you just have to be aware that there's no predictable return on investment in an equity investment. The upside is there's a lot of upside if the property does really well. The downside is there's a lot of downside if the property does not go well, or if the deal does not go well. And here's what I mean by that. You are not secured the same way as you are in a debt loan. In a debt loan, there's a promissory note and mortgage, and you're listed as an additional insured. In an equity investment, you are an actual member of the LLC. Some people prefer this, some don't. Again, depends on your personal preferences. The reason you might want to prefer is because you can put language in that operating agreement that says if the operator messes up, or if they lie or cheat or steal, you can then take over the property and take over the operations of the property without having to foreclose. On a debt loan, you have to foreclose in order to get that property. There's some other ways. You can get a deed in lieu of foreclosure and some other things like that, but typically you have to foreclose. So it's a longer process, more legal fees, it's more extended. With an equity investment, you can just put verbiage in the operating agreement that says that you can take over the operations should things not go as planned. So that's one thing to be aware of. You don't have a promissory note, you don't have any sort of mortgage or security other than your interest in the LLC. Just something to be aware of. Some people, again, prefer it. Some people would prefer a mortgage and a note. So the upside in having an equity investment is typically the equity investor has a lot of equity in that LLC that owns the building. So you might have 123 Main Street owned by 123 Main Street LLC, and 123 Main Street LLC might be owned 50% by the equity investor who brought 200 grand and 50% by the active operator who's doing all the work on the property. This is actually how I got started in real estate. I had some equity investors who put up a few $100,000. That ended up turning into a little over $1 million, but they had 67% of the first 250 deals, 250 units that I acquired. Now, I did that because it made a lot of sense, because I didn't have to bring any of my own money. It gave me the opportunity to go out and learn on their time and on their dime, and they got a big chunk of all the deals and all the work that I did. So it was also a very sweet deal for them. Unfortunately, that partnership broke up and we went our separate ways, but I understood what an equity investor was looking like because I structured that partnership that way. I also understood what debt investors look for. And there's benefits and downsides to both. So when I started investing heavily in apartments, I've never taken a class on this stuff. I've never read a book on this stuff. It's all from the School of Hard Knocks. And because I come from the world of single family investing, but I also have a little bit of background with the equity investments on the equity side and doing mostly debt type of loans on the single family side, I realized there were benefits and downsides to both. And what I noticed was that a lot of investors wanted that predictable return on their investment, but they still wanted the upside and the benefits of having a little bit of equity. So what I ended up doing was, essentially responding to the market. And the marketplace said, hey, we want a hybrid of debt and equity. And that's what we ended up putting together. So the way that I structure my deals today is a hybrid of both of those, offering the both with very little downside. So what we do is we will pay a fixed return on investment to an equity investor who invest in one of our apartment buildings. It will pay them a fixed return on investment while their money's invested, regardless of the property's performance. So we'll just make sure that we buy it low enough to create an interest reserve, assuming if the property is not cash flowing well enough and not performing at a high level, we will create an interest reserve and make sure that the investors still get paid out of that interest reserve. That way the investors invest with us and they get quarterly dividends distributed to them on a very predictable basis, and they know they're getting a great fixed return on their investment. My entire model is based on the BRRRR method, which is buy, renovate, rent, refinance, and then rinse and repeat. So we'll buy an apartment building that's worth $10 million once it's stabilized. We'll be all into that apartment building for around $7 million. And the bank will give us a loan on that $7 million of about 80%. So let's say the bank brings $5.5 million. That means we have to bring equity investors for the other $1.5 million. That can come from one person who strokes a check for $1.5 million, or it could come from 15 people who each bring $100,000 apiece. Regardless of how many investors we have, those investors will earn a fixed return on their investment while their money's invested. with that $7 million, we buy the property, we renovate the property, we put good tenants in place, we put good management in place, and then after about 24 to 36 months, we refinance that property. At that time, we'll go to a new lender, let's call it an agency like Fannie Mae or Freddie Mac, who will appraise that property at $10 million. And based on that new value, they'll give us a loan at, let's call it 75% LTV, loan to value. So they give us $7.5 million. With that $7.5 million at the time of the refinance, we pay off the bank loan, the original bank loan of 5.5. We pay back our equity investors of 1.5 million. And then there's still about $500,000, about $500,000 of non-taxable refinance proceeds that get carved up amongst all the different owners. So our investors get a fixed return while their money's invested. Then they get all their money back at the time of the refinance. And then they maintain equity in the deal in perpetuity. So because it's a little bit of a hybrid, we might give them 25% equity in the deal in perpetuity instead of maybe 50% of the equity in perpetuity, but then they have predictable return on investment with limitless income potential. That way they get a percentage of the refinance proceeds, they get a percentage of cash flow even after all their money's been returned to them, a percentage of all the depreciation, and they get their percentage of future sales proceeds and future resale proceeds down the road. So it's a good hybrid of both. So if you're looking at passively investing in real estate, think about where your appetite is and what type of deals you want to do. There's debt investments that give you a predictable return on investment but no real upside or downside. There's straight equity investments that have no predictability to the cash flow, but they have big upside or potentially big downside. Or there's hybrids, kind of how we structure it, which has the predictable cash flow and has equity upside without the downside risk. So it's up to you. What are you looking for from a passive investment standpoint? Hey, I appreciate you watching. If this was helpful for you, please share it with somebody else who looks at alternative assets and looks at investing in apartments or real estate in general. Let them know that there's other opportunities out there that's outside of the stock market and bonds and certificates of deposit at the bank account that pay little to no return or have a lot of volatility in the returns. Let them know that they can invest in tangible assets like real estate, and that there's many different ways to invest in real estate depending on what your tastes and preferences are and what your risk tolerance is. If you're looking for short-term loans that have a little bit more velocity on them, or if you're looking for more long-term loans to build real wealth. So if this is helpful for you, please like, share, subscribe, and click the little notifications bell so you get more videos as we release them coming up. So appreciate you. Be your best.